Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing from Oramed Pharmaceuticals Incorporated, which is a bit of a head scratcher because it is not exactly about sales and profits, but something else entirely. Before we dig in, if you are loving these deep dives into company filings, make sure you are subscribed. And hey, we have a fantastic Discord community brewing where we discuss these filings and much more. You can find the link in the description. So Oramed Pharmaceuticals Incorporated has filed an 8K report, and this isn't your typical quarterly earnings report. Instead, it is all about something called a dividend declaration of what they're calling stock purchase rights. Now, what does that actually mean for us trying to understand the company's health and direction? From what I can see, this filing is dated the 16th of November 2025, and it is essentially announcing that the board of directors has decided to give every shareholder a right for each share of common stock they own. This is ORMT, the company we're looking at. They are incorporated in Delaware and have a commission file number of 001-35813. Their IRS number is 98-0376. 008. Their common stock is traded on the Nasdaq Capital Market and the Tel Aviv Stock Exchange. The big news here is that on the 16th of November 2025, Oramed Pharmaceuticals Incorporated declared a dividend, but it is not a cash dividend or a stock dividend in the usual sense. Instead, they are issuing what is called a common stock purchase right, or a right for every share of common stock outstanding. These rights are planned to be paid out on the 27th of November 2025 to shareholders who are on record by the close of business on that same date. Each right now allows the holder to buy one share of the company's common stock for $10. We see this kind of thing sometimes when a company wants to protect itself. So what usually happens is that these rights don't become active immediately. They are tied to something called a distribution date. This date is triggered if a person or a group of people acquires a significant chunk of the company's stock, specifically 15% or more, or if a tender offer is announced that would lead to such an acquisition. Think of it like a poison pill, designed to make it much more expensive or difficult for an unfriendly party to take over the company. Until this distribution date, these rights are basically attached to your existing shares. You can't trade them separately. When you buy or sell the company's stock, the rights go with it. It is only after the distribution date, if it ever happens, that separate certificates for these rights will be mailed out. And importantly, these rights themselves don't give you any shareholder perks like voting rights or dividends. They only give you the option to buy stock at a set price under specific conditions. Now, these rights aren't going to last forever. They have an expiration date. In this case, they are set to expire 3 years after the date of the rights agreement, unless the company decides to redeem them sooner. Redemption is when the company buys back these rights from the shareholders. They can do this before the triggering event, but there is a catch. They can only redeem them at a very small price. In this filing, it mentions a redemption price of $0.012 per right. This is essentially pocket change, and it is another mechanism to neutralize the rights if the company decides to. The filing also talks about adjustments to the purchase price and the number of shares you can get. This is standard language to make sure that if the company issues more stock, splits its stock, or pays stock dividends, the value of these rights stays fair and doesn't get watered down. It is all about maintaining the intended protective mechanism. This is where things get really interesting from a takeover defense perspective. If someone becomes an acquiring person, meaning they cross that 15% ownership threshold, then every other shareholder gets the right to buy stock for half its market value. Let's say the stock is trading at $20 and the right allows you to buy it for $10. You could exercise your right, buy a $10 share that is actually worth $20. This is designed to dilute the stake of the hostile acquirer significantly, making their acquisition much more expensive and less desirable. Imagine if an acquirer bought 15% of the company, and then suddenly everyone else could buy shares at half price. That 15% holding would quickly become much less than 15% as new shares are issued. And it gets even more potent if an acquiring person takes over the company through a merger, or if the company sells off a huge chunk of its assets. Existing shareholders can use their rights to buy shares of the acquiring company itself at a discount. So if Oramed Pharmaceuticals Incorporated is bought by Big Pharma, holders of these rights could potentially end up with shares of Big Pharma, again valued at twice the exercise price. This makes the acquisition incredibly costly and dilutive for the acquirer. The board also has the option, after an acquirer becomes identified, to swap these rights for shares of Oramed Pharmaceuticals Incorporated's common stock. This is another way to dilute the acquirer's stake and potentially make the takeover less attractive depending on how it is structured. It's a complex set of maneuvers designed to give the board leverage and protect existing shareholders from unsolicited bids. This filing on item 3.03 basically says that the information from item 1.01, which we've been discussing, directly impacts the rights of Oramed Pharmaceuticals Incorporated security holders. It is a formal way of saying that this new dividend of rights fundamentally changes things for shareholders. And to really nail down the details, the company has attached the full rights agreement as an exhibit. This is the legal document that spells out all the nitty-gritty terms and conditions of these rights. It is essentially a contract between Oramed Pharmaceuticals Incorporated and a third party, Continental Stock Transfer and Trust Company, who will act as the rights agent, the administrator of these rights. They also attached a press release from the 17th of November 2025, which is usually their public announcement about these kinds of corporate actions. The report is signed by Nadav Kidron, who is the President and Chief Executive Officer of Oramed Pharmaceuticals Incorporated. This tells us this was a decision made at the very top of the company. Now, looking at this filing, it is crucial to understand that this isn't about a change in Oramed Pharmaceuticals Incorporated's operational performance. Like a sales boost or a new product launch, this is a defensive maneuver. It suggests the company's leadership might perceive a potential threat of a hostile takeover, or they simply want to bolster their defenses against future unsolicited offers. From a shareholder's perspective, this move can be seen in a couple of ways. On one hand, it could be a positive step to protect the company's long-term strategy and prevent a hasty sale at a low valuation, especially if their stock is currently undervalued in the market. It gives the board more time and flexibility. On the other hand, these poison pill provisions can sometimes deter all potential suitors, even friendly ones, and might lead to management entrenchment if they're not genuinely acting in the best interest of maximizing shareholder value. It is a tool that, when used correctly, can benefit shareholders, but it can also be misused. Right now, the key takeaway is that Oramed Pharmaceuticals Incorporated is proactively taking steps to make itself a less attractive target for unwelcome acquisition attempts. Whether this is a sign of strength, with the company confident in its future, or a sign of underlying vulnerability, is something that time and future filings will tell. We'll be keeping an eye on any further developments with Oramed Pharmaceuticals Incorporated to see how this strategy plays out. Alright, that is our breakdown of Oramed Pharmaceuticals Incorporated's latest unusual filing. What is your take on these rights and what they might mean for the company's future? Do you see it as a smart defensive move or a sign of trouble? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribing ensures you don't miss future deep dives. And don't forget to join our Discord community, linked in the description for more discussions and insights. Thanks for watching, and we'll see you next time on Corporate Decoder.